The stock market this past week has been extremely volatile. The Ark Innovation Fund is down just today 6.71%. WCLD is a high growth cloud computing ETF and it's down 6.57%. ESPO, a video game ETF, is down 3.34%. The QQQ is down 1.7%. And the S&P 500 is down 1.11%. And looking at the past 5 days in the market, it has been extremely volatile, lots of up and down swings, and zooming out to the 1-year view, we are going through a somewhat substantial pullback. So in this video, we're going to go over what's happening, what's the reason behind all of this insane price action, and that's going to be followed by my top 5 income-focused ETFs, because I think especially right now, these are a safe haven asset to be investing in. But let's begin with some news and some background on what exactly is going on. And really quick, if you guys enjoy my content, as always, leave the video a like, subscribe to the channel. It helps me out a lot and it's greatly appreciated. So a lot of news has happened this week and it's only Wednesday so far. So the week began with the Dow dropping 650 points on growing concerns over the Omicron variant, as well as news from the Fed. So Jerome Powell, the head of the Fed, talked about speeding up their taper faster than expected. So beginning with the Fed news, the reason behind the speeding up of this tapering process is both good and bad. So the first reason is that right now the economy is actually pretty strong. There's lots of demand circulating within the economy, mostly due to the loose monetary policy. But unfortunately, that has also increased inflationary pressures. So due to this overall situation, the Fed is going to be speeding up their tapering process in order to pivot from supporting the economy to combating inflation. And of course, the economy doesn't like that, and that's one of the reasons why there's a lot more turbulence in the stock market this week. And the second major piece of news is the emergence of the Omicron variant. Now, this news first broke back around November 24th, and that's what caused this correction of roughly 2.2%. However, today, the US officially confirms the nation's first case of the Omicron variant in California. Now, ever since this variant emerged, it was basically inevitable that this was going to arrive in the US at some point, but today those fears have been realized, and that's a big reason why today the stock market is down another 1.11%. So those are the two major pieces of news, the Fed and the Omicron variant, that's causing all of this up and down and just general uncertainty in the market over this past week. And taking a look at the VIX, which is a measure of uncertainty and volatility in the market, this past week it has been fluctuating up and down with the market, but overall it's up 42%, which is pretty significant. If we zoom out to the past 1 year, this is a pretty meaningful spike on the VIX, and it's even surpassing the levels we had back in May when a lot of the tech names sold off. Now, during times of heightened uncertainty and volatility in the market, I'm really glad I invest in income-focused assets. Now, I do love my growth assets, don't get me wrong. Over long periods of time, averaged out, they tend to do very well. But during times like this, it can be quite difficult to hold on to these assets. So as we saw before, the Ark Innovation ETF is down 6.71% just today, and in the past month, it's down 12.8%. Even IGV, which is an expanded tech software ETF, is down 4.26% today, and over the past month, it's down 5.5%. And in stark contrast to that, an income-focused ETF like Divo is only down 0.28% today, and over the past 1 month, it's down 2%. So it's definitely not immune to these market conditions, but we can see the greater stability and more predictable returns found in these funds. And that's just the price appreciation. That's not even talking about the income that these assets produce. If I come over to the activity page on my brokerage, just yesterday, Divo paid me their hefty dividend. And comparing this payment versus previous ones, first thing to note is that it's right on time, as scheduled, and second, it's a very consistent and growing amount. So considering the comparatively minute price movements and the very consistent nature of dividend payments, income-focused ETFs are some of my absolute favorite investments, and during times like this, I'm glad that I have them. And on that note, I want to share with you guys my top 5 favorite income ETFs at the current moment. And for those that have been following the channel, you know that I like to have ETFs that have 2 income sources. So the first one is income from options, and the second is traditional dividends. And the reason why I like to have these 2 income sources is because 1, dividends are great, they're extremely stable. Comparing it versus the price action of the market, dividends are way more reliable because they're paid from the balance sheet of profitable blue chip corporations. But unfortunately, because of the insane price movements over the past couple of years, dividend yields are at an all-time low, even though the payouts that companies are paying are at an all-time high. Now, usually you could supplement this using bonds and interest, But unfortunately, again, in this economy, that's just not an option. And this is where options come into play, in my opinion, because you can collect a nice yield off of selling call options, which can boost dividend income. Now, call options do have their downsides, namely that they limit upside potential, but they also have a very unique set of advantages. So this table here is the impact of price and volatility changes on long and short option positions. The call options I use are categorized as short calls, and we can see that in the situation of a falling stock market and a rising volatility index, the premiums collected by these call options increase. So that's just another reason why I like to have options along with very stable and consistent dividends in my income-focused ETFs. Alright, so that's my argument on why I like these funds, and here are my top 5 choices. We have Divo, SCHD, jepi, XRMI/NUSI, and XYLG. I've made in-depth videos before on all of these ETFs, so search the channel or YouTube for that matter if you want to watch those videos. But all these funds differ slightly in the way that they generate income and just operate in general. So in their options, they could be systematic or they could be actively managed, they could rely purely on dividends, or they could use some kind of a hybrid income strategy. So even though these are my top 5 choices, I like them all for different reasons. So Divo, for example. Divo is actively managed when it comes to their option strategy, but they also invest in a lot of dividend-paying companies, and because of that, they're a hybrid option. And this hybrid nature of Divo is one of the things that makes this ETF super special and one of my absolute favorites. The only knock is that the option policy is actively managed, and you have to rely on the management of the ETF to provide consistent option income. So far, it's been extremely effective, but it is a potential weakness of the fund. Now, that's where an ETF like XYLG comes into play, because they use options, but they have a systematic approach. So XYLG along with qylg covers half of the S&P 500 or the QQQ respectively with the covered calls, and the other half is free to grow along with the market. And as mentioned, those covered calls are systematic, so there's no human input. All it is every month they buy an at-the-money covered call on half of the index. And if we compare XYLG versus Divo side by side, their price movements are strikingly similar, even though their strategies are completely different. And due to its very simple systematic approach, XYLG is one of my absolute favorite income-focused ETFs. It's a good mixture between growth and exposure to equities, as well as income from systematic covered calls. Now the next one, SCHD, is just a pure dividend-focused ETF, and it's one of the best on the market. So if you're not a fan of options and the potential risk and complications that come along with them, SCHD and its pure dividend nature is a great safe choice. They still have a modest yield of 2.9%, and today it only went down 0.46%. Over the past 5 days, it's only down roughly 3%, and over the past month, it's down a modest 2%. So it's a great ETF full of blue chip dividend-paying companies. Now moving on, the next one on my list is jepi, and jepi falls right here along with Divo. This is the second and final ETF on this list that has an actively managed option strategy. Now, unlike Divo, this uses ELNs, which are a bit more complicated version of a call option, but ultimately it has a very similar effect. But the ELN nature of this ETF versus Divo, which uses traditional call options, allows it to have a slightly higher yield at 6.2%. Now, it's important to note that unlike Divo, jepi is not a hybrid income ETF. So as mentioned, the core of Divo's ETF is blue chip dividend paying companies with some actively managed covered calls on top of it. jepi, on the other hand, essentially relies fully on ELNs for the vast majority of the income this ETF produces. And the equity positions that jepi does invest in, they focus on undervalued companies and other metrics like that, not dividend paying companies. And this leaves us with my final favorite income-focused ETF, which is XRMI/NUSI. So this is a risk-managed income ETF, making it slightly different than all the other options on this list because they utilize a put option. The put option is going to limit your downside potential, and XRMI uses a systematic approach on those call options and the put options. So much like with XYLG, they buy at-the-money call options on, in this case, 100% of the portfolio every single month, but then they take some of that premium collected and they use it to buy protective puts that are 5% out of the money each and every month. So ultimately, you're going to have slightly less income, but the trade-off is that you're going to have greater downside protection. And this is known as an option collar strategy, and NUSI is the most popular ETF that uses an option collar strategy. But the thing that makes NUSI different is that it's more of an actively managed option strategy. It's not quite as systematic as XRMI. But there you have it, guys. These are my top 5 income-focused ETFs that are great in volatile market conditions like we're currently going through. Dividend income provides provides a great, very stable level of consistent returns when the price fluctuations of the market are haywire, and selling call options can boost that income, especially when the market is volatile because the option premium collected goes up in volatile markets, almost giving you a kind of hedge against volatility in the market by increasing your income level. But that's all I have for you guys today. If you guys are still watching and enjoyed, as always, give the video a like, subscribe to the channel, helps me out a lot and it's greatly appreciated. But regardless, I'll see you guys in the next one.